Welcome to the Deep Dive. We are jumping right into the latest market catalyst today. Our focus is the Q3 2025 results for Waste Connections, Inc., that's ticker WCN, following their pre-market callback on October 22nd.
Yeah, this was a really interesting one. I mean, WCN, they faced these ongoing commodity headwinds, right? Prices for recycled stuff were just low, but they still managed to deliver results above what the street expected.
So this deep dive is really about how they pulled that off.
Exactly, how they synthesized, really strong operational execution with some smart capital moves. And the market, well, it seemed to like the story.
Okay, let's unpack it then. Our mission here is to break down the key financials, figure out what drove that margin expansion they're talking about, and then look at that initial framework they laid out for 2026. That seems crucial.
Definitely. If you want an inside track on WCN's strategy right now, this is it. So let's start at the top. Those headline numbers that got the market's attention.
Right, the numbers. They looked, well, pretty solid. Revenue was $2.458 billion. That's up 5.1% year over year, and it beat the consensus expectations.
Yeah, a solid top-line beat.
Now, EPS, you got to look closely here. The standard GAAP EPS was $1.11, but the number everyone really watches, that non-GAAP adjusted EPS, that came in at $1.44, significantly up from $1.35 last year.
And that distinction is really key. We focus on adjusted EPS because it strips out things like, say, one-off acquisition costs or impairments. It gives you a cleaner view of the core business's profitability, and that's where the quality of this beat really shines through.
How so? What points to quality there?
Look at the adjusted EBITDA, $830.3 million. That translates to a margin of 33.8%, which is, frankly, impressive in this environment. The core story, like I said, is durability. They got about 80 basis points of underlying solid waste margin expansion.
80 basis points while commodity prices were weak.
Exactly. Pulling that off signals that the underlying business, the core operations, are running really efficiently. It's a high-quality beat.
Okay, so let's dig into that. The 80 basis points. Management kept saying superior execution.
Yeah.
Sometimes that's just corporate buzz, right?
Yeah.
But here it seems, well, real, financially real. Where do we start? Pricing.
Pricing is definitely part of it. Core solid waste price growth was 6.3%. That's strong, shows they have pricing power. But here's the twist. Reported volumes were actually down 2.7%.
Whoa, hang on. Volume down 2.7%. In waste management, isn't volume kind of critical, especially with all those fixed assets, the trucks, the landfills?
It is critical, and letting volume slip can be risky, absolutely. But the way management framed it, a good chunk of that was, and this is their phrase, purposeful and margin accretive shedding of low-margin contracts.
Purposeful shedding, so they're actively dropping customers.
Or choosing not to renew certain contracts, yeah. If a route isn't profitable enough, maybe it's too far out, or the customer demands rock-bottom prices, they're making the tough call to let it go. They're prioritizing profit margins over just growing the top line at any cost.
Okay, that makes more sense. Focusing on efficiency, higher quality revenue.
Yeah.
But you mentioned another angle, the sort of hidden lever, the human capital side. The labor catalyst.
Absolutely. I think this is the real differentiator for WCN lately. It's their self-help story, if you will.
Mm-hmm.
They reported voluntary employee turnover was down again for the 12th consecutive quarter.
12th. That's 3 straight years of improvement. How much has it dropped overall?
Over 55% down from the peak levels they saw a couple of years back. That's huge in this industry.
That is extraordinary. You hear constantly about driver shortages, technician turnover across the whole industrial space. So for listeners, maybe connect the dots. Why does keeping the same drivers and mechanic actually save money? What's the financial payoff?
Oh, it's massive financial leverage. Think about high turnover. You're constantly paying recruitment fees. You're spending tons on training new people who aren't efficient yet. You often run into overtime costs because you're short-staffed. WCN's success here, it means less spending on expensive third-party temporary labor. It means lower maintenance costs because experienced staff, frankly, treat the equipment better. Fewer mistakes, fewer repairs.
And they mentioned safety too, right?
Yeah, record low safety incident rates. Down over 25%. Fewer accidents means lower insurance costs, less downtime, fewer repairs. It all flows directly to that underlying margin improvement. They're explicitly linking better employee retention to better financial results.
Okay, so that internal operational strength seems really solid. And that confidence seems reflected in how they're using their cash too, right? Dividends, buybacks.
Definitely signals confidence in the free cash flow. The board approved an 11.1% hike in the quarterly dividend. It's up to $0.35 now. And get this, it's the 15th consecutive year they have announced a double-digit percentage increase.
15 years of double-digit hikes. Wow. That tells a story about predictability.
It really does. Shows extreme confidence in long-term cash generation. And they weren't shy about buybacks either.
Right, taking advantage of market conditions.
Seems like it. They repurchased about 2.4 million shares this quarter. That's nearly 1% of their outstanding shares. They did it through their normal course issuer bid, the NCIB, which is basically, a preset plan companies use to buy back stock when they think it's undervalued. Shows smart capital allocation.
And M&A. That's always been part of the WCN playbook, buying smaller players in specific markets. Still active there.
Yep, still humming along. Acquisitions were actually above their average pace. They closed or signed deals representing about $300 million in annualized revenue so far this year, including 2 pretty significant private company deals down in Florida. Fits right into that strategy. Find good assets in secondary or exclusive markets where there's less competition.
Okay, so strong quarter, good execution, smart capital use. Let's pivot to the future then. Full year 2025 guidance was reiterated, which is good for stability, but everyone's eyes are on 2026 now. What's the early word?
Right, 2025 looks locked in. About $9.45 billion in revenue, $3.12 billion in adjusted EBITDA, and $1.30 billion in adjusted free cash flow. Pretty much unchanged. For 2026, the very initial high-level framework points towards mid-single-digit revenue growth. So think maybe 4-6%.
Okay, mid-single digits and margins. After hitting 80 basis points of underlying expansion this quarter, what are they guiding for next year? More of the same.
This is where it gets interesting. They're guiding margin expansion back to what they call the normalized range. That's only 20 to 40 basis points for the full year.
Only 20 to 40 after 80. Why the step down? What's dragging it back?
That's the key question investors had. Management flagged 2 specific headwinds they expect to offset. First, M&A dilution. They figure acquisitions will dilute margins by about 10 to 15 basis points initially.
Because the companies they buy aren't as efficient as WCN yet.
Exactly. They have lower margins to start, and it takes time for WCN to bring them up to standard. So that's headwind number 1. Headwind number 2 is commodities. Still a factor.
Okay, so the weak recycling prices and what else? You mentioned RNs earlier.
Right, RNs, renewable energy credits. These are credits they generate and sell from their landfill gas-to-energy projects. The combined impact of weak recycled commodity values and lower RN values is expected to be a 20 to 25 basis point drag on margins next year.
Just how bad was the drop in RNs and recycling prices?
Pretty bad. They said values slid something like 30 to 35% year over year. That's a significant hit to those ancillary revenue streams. So they need that core solid waste business to perform exceptionally well just to offset those drags and still hit that 20-40 BPs overall expansion. They're still confident they can maintain a 150-200 basis point price-cost spread in the core business, though.
That explains the normalization. Makes sense. Okay, let's talk tech. That seems like a big part of their longer-term story for efficiency gains.
Yeah, they're leaning into it. They're in the midst of a 3-year total digitization plan that wraps up in 2027. And they said early deployment of data analytics, some AI tools, specifically for things like pricing optimization and forecasting, has shown a very rapid payback.
Rapid payback? Like what? Any specific examples?
The standout example was customer churn. In the parts of the business where they've rolled out these new pricing and analytics tools, they're seeing a 30 to 40% reduction in customer churn.
30 to 40% reduction. That's huge. That directly fights that volume headwind we talked about earlier.
Absolutely. If you can predict who might leave and why, you can intervene. Maybe offer a different service level, adjust pricing proactively. You keep the customer, it stabilizes the base. That has massive implications for organic growth if they can scale it.
So what's next on the tech roadmap?
For 2026, the big push is real-time route optimization. They kind of joked about it being like Waze for garbage trucks. But seriously, think dynamic routing, avoiding traffic, finding the most efficient paths. It saves fuel, saves time, and importantly, it makes the drivers' jobs easier, which feeds right back into that crucial employee retention success story. This tech is aimed directly at pulling maybe 50 to 100 basis points out of that historical churn-related volume drag.
If they can do that.
Yeah.
That really could change the growth profile. Okay, shifting slightly, the big RNG projects, renewable natural gas. If RN values are down, does that push back the timeline for those big investments?
It does. They were pretty clear. Don't expect material revenue or EBITDA contributions from the new RNG investments until 2027. The project economics have shifted a bit. Costs are up, REN values are down. That simple $1 in, $1 out math for EBITDA isn't quite there right now. It's closer to 2-to-1 investment for $1 of EBITDA. So they've actually reduced their green CapEx spending for 2025, pushing some of it into 2026, being disciplined with capital.
Makes sense. Okay, one last operational point. Chiquita Canyon, that legacy landfill issue. Any updates there?
Yeah, they gave an update. Sounds like mitigation's progressing pretty well, actually. The key metric they highlighted was leachate removal. That's the contaminated liquid. They're removing 220,000 to 240,000 gallons per day. And crucially, that removal rate is now higher than the rate the underground reaction is generating new leachate. That suggests they might be getting ahead of the problem.
And the odors. That was the big community issue.
Odor complaints are down over 95%, which is a huge improvement. They did say spending this year is running a little higher than planned because they accelerated some steps, but the overall total estimated cost for post-closure care hasn't materially changed. Seems like a contained, though complex, issue now.
Okay, good update. Now, it's time for our, let's call it infamous segment. This is not financial advice. Based on everything we've heard, strong cash flow, smart capital returns, operational grip, give us an outrageous, but maybe, just maybe, plausible trade idea.
All right, let's step into the hypothetical analyst shoes here. Thesis first. WCN's operational stability is rock solid. FCF is durable. The stock often trades at a premium, yes, but we think the options market might be underpricing just how stable this business is. Implied volatility seems maybe a bit too low given the consistency. So we want to monetize that perceived stability, maybe collect some premium, while still having upside exposure to the M&A story and the tech RNG kicking in later.
Okay, monetize stability, keep the upside. How do we structure that? Sounds tricky.
It's a bit complex, but here's the pitch. A synthetic long position. We milled it using a ratio call spread combined with selling a naked put. And we go pretty far out, say, June 2026 expiry.
Whoa, okay, break that down. Naked put right and right. What's the thinking there?
Right. We sell a deep out-of-the-money put option. Why? To collect premium up front. We're essentially saying, we believe the stock is unlikely to fall below this low price thanks to its strong cash flow, and we're willing to buy it there if it does. We get paid for taking on that arguably low probability risk.
Okay, collect premium from the put sale. Then the ratio call spread. What does that do?
We use the cash collected from selling the put to help finance the call spread, specifically a 1-by-2 ratio call spread. So maybe we buy one call option at a lower strike price and sell 2 call options at a higher strike price. This gives us leveraged upside exposure if the stock moves moderately higher. We're betting that the ongoing M&A, maybe a clean Q4 print with easier comms, could push WCN towards, say, the 190s or even $200 by late 2026.
So the put collects premium based on stability. The ratio spread uses that premium to create leveraged upside.
Exactly. It aims to minimize the net cash you have to put out up front while giving you that asymmetric exposure if the stock grinds higher on the back of that consolidation and efficiency story. It's a way to play the operational momentum.
Outrageous, but plausible indeed. Okay, let's wrap this deep dive on Waste Connections Q3. Key takeaways for me. Really impressive operational execution, especially keeping employees, which is driving that margin beat. Strong capital returns the dividend hike, the buybacks showing real confidence, and that tech roadmap looks promising for future efficiency.
Yeah, I think the most compelling piece is that direct link they're showing between managing their people well and expanding margins. It's a powerful example of, internal self-help kind of masking the softness in the broader commodity markets, real operational discipline.
So here's a final thought for you, the listener, to chew on. Management specifically said their pricing strategy and those new AI tools could potentially reduce that volume drag from customer churn by 50 to 100 basis points. Now, if they actually hit that goal in 2026, what does achieving positive organic volume growth really mean for this stock's historical growth algorithm and maybe its valuation multiple? Something to consider.
Definitely something to think about. Thanks for tuning in.
We appreciate your curiosity and look forward to our next analysis.